Okay, the stock which is currently on our radar right now is Dabur. It's been buzzing of late. In fact, it's gained about 3% today. It's up about 10% since the start of November. How is the rural demand shaping up? With the state and general elections have any impact on the business? To discuss this and more, Sunil Duggal, the CEO of the company, joins in on the phone line. Mr. Duggal, afternoon, and thanks so much for joining in. Generally, if you could tell us, how does the rural demand pan out ahead of an election? And, you know, the manifestos of both the parties, BJP as well as Congress, seem to have a bit of a populist tone. So they're talking about, you know, farm loan waivers, etc. Basically, more money in the hands of the poor people, which would only help a consumption company like Dabur. So your thoughts of how, you know, the next 6 months could be for the company?
The last few months, the consumption has been steady, but nothing spectacular. It's been trending in the high single digits. We do think that there's every chance of stimulus being heightened in the run-up to the elections. That's typically what we see during the election year. We saw that in 2014, and perhaps the same repetition could happen now. In which case, of course, there will be an upsurge in consumption, which will benefit companies like ours. But it's still early days yet. We still have around 6 months to go for the elections, and let's see how things pan out.
Okay. Mr. Duggal, good afternoon, sir.
Good afternoon.
You are expecting this stimulus perhaps to really come through. Now, the point of debate has been, whom does it benefit? You know, ahead of elections, if there's a lot of money in rural markets, does it typically benefit discretionary consumer companies more, or a company like yourself? Do you think the benefit will also flow through in the FMCG space? I mean, would you at all look at, for instance, perhaps increasing your own expectations on the full year volume guidance?
Well, it's too early to revise the guidance, which still trends in the high single-digit volumes. Having said that, any stimulus would fuel consumption, both of staples and discretionary. It depends upon the quantum of stimulus. If it's high, then discretionary space will benefit more. If it's low, then the staples would be, but ultimately it'll benefit both. Now, again, with the run-up to the elections, especially given yesterday's results, we do expect the stimulus from the government, the chances of stimulus increasing, in the run-up. How much and when, it's very hard to say. But I think the consumption story has strengthened a bit post what has happened in the last few days.
Even in the December quarter, you're saying that the volume growth has been in high single digits. Has not the festive season boosted your sales and pushed it towards the double-digit mark?
Well, the results are still to come out. We have another month before we publish results. So let's see how December goes. So far, the demand, like I said, is steady. There has been a little bit of uplift on account of the shift in season. So therefore, the base quarter was a little bit lower than normal, and we would benefit from that. But I'm saying the underlying demand, without having any quarterly focus, is at the moment trending in the high single digits. And it could trend up into double digits if the stimulus is substantial. Or it could remain where it is. It's very hard to say. So
right now you're in, high single digits. We need to see if that gets into double digits. For the year as a whole, as of now, you're sticking to the low double digits growth guidance that you'd given as of now?
Yes, I think that is what it looks like. Of course, we did have a extraordinary first quarter on the back of the weak base. And since then, the growths have been trending in the, 8 to 10% trajectory. So with the uplift we got in the first, the full year should be in double digits. But let's see whether it can trend in double digits, let's say from the fourth quarter onwards, when the stimulus, if it comes, could boost demand.
Okay.
Third quarter, of course, is more or less over, so we're not seeing any great uptick compared to what we saw earlier.
So you're hopeful of a low double digit, say by Q4. Sir, if you could just tell us, how have input costs panned out? Because when we spoke to you last time, you indicated that they could inch up in Q3. But we have seen crude prices ease a bit. So just walk us through how the raw material pressures have been for you in the current quarter.
Well, it's eased up quite a bit. We did think that in the end of second quarter that inflation would kick in by the third. It hasn't. So the effects of the low inflation would be felt in the fourth quarter, because in the third quarter we'd already bought into our consumption basket. But definitely inflation is benign and has really not been an area of concern anymore.
So slightly sort of off question, not exactly P&L related, but is there any change from Patanjali? Because we know that the numbers didn't quite look as good, and there was talk of perhaps them changing track, changing strategy. Has any of that started showing up in the market in some of your key categories? Is there something you foresee ahead?
Well, honey is a case in point where we did lose share to competitors, and we've regained that. Having said that, now honey is on a pretty normal base of last year. The share regain happened in the last 3 or 4 quarters. So now we are still trending into strong double-digit growth, but largely on account of organic reasons rather than market share-related reasons. I think those have been played out. Remember, the growth was in 30-40% in the past 2 or 3 quarters. It's trended down a little bit off those highs, but still is showing very strong growth. I think the market for honey expanded as and when affluence spreads, people start shifting to high-value products like honey from sugar, and hopefully this will be part of a long-term growth story for honey.
Okay. In fact, on the subject of competition, Colgate seems to have upped the ante in the naturals business, so Ved Shakti as well as Swarna Shakti. Is that impacting you in any way?
Well, there's a lot of competitive froth at the lower end of the market with, Colgate and Patanjali now really getting into this space with a lot of effort and resources. So, to some extent, the performance of one of our brands has been muted, Dabur, but because that operates in the low-price space, which has, like I said, become far more competitive. But our high-price brands, whether it's Red or Miswak, continue doing extremely well. So the mix is changing in our favor, and while we do tend to resurrect Dabur, the heartening thing is that the premium part of our portfolio is performing exceedingly well.
So just to go back on the honey bit, you said you have regained, of course, market share from Patanjali. But where would it sort of stack right now? Because I guess, as our colleague Mangalam was also telling us, the company's stated objective has been to focus more on market share gains. So if you could just share that number?
I think in honey, it's more of market expansion, like it is with Chyawanprash. We are training in 50, 60 shares. Honey shares are very hard to absolutely pin down because there's no mechanism for tracking it. So we rely upon our own household panels, and we see it at around 55, 60. So share gains is not really very material here because it's very hard to gain share beyond 60%. Our role is market expansion to get consumers to consume honey for health, fitness, as well as a better substitute for sugar. And that really is what will grow our business rather than market share gains.
Okay. Since we're on the subject of your various businesses, any business that you'd like to call out where you've seen some exceptional growth, seen some increase in market share apart from honey, and any segment which you'd like to call out with caution where increased competition has impacted you apart from the low end of the toothpaste market?
Most of the HPC portfolio is doing very well. The hair oils, in fact, is showing extraordinary growth. All of hair care is showing very good growth. Oral care, like I mentioned, the premium end is doing very well. And some of the skincare products are doing also very high double-digit growth. So HPC, by and large, is doing well. Supplements have been a little subdued on the back of delayed winters, but we expect them to pick up this month and the next. And the beverage piece is also a little bit subdued on the back of perhaps a little bit lesser demand, aggregate demand. Category growths have tapered off a little bit. And very intense competition, which also it does make some impact. Overall, we still would see, hopefully, double-digit growth emerging this quarter from beverages, but there is some stress there.
Okay, so to round things off, back to the margin question, because now oil prices have surprised pleasantly on the downside. Because when we spoke to you after the second quarter, there was that fear whether this escalating price is going to really start impacting margins. Full year basis, given where oil is, where do you expect margins to be?
The margin impact, which is obviously benign, will really be material only in Q4. The first 2 quarters, there was inflation. Third quarter, while there was deflation, we are already consuming the higher-priced material. Q4, we'll see some benefits, and hopefully if inflation continues on its current trajectory, we would see substantial amount of margin expansion happening next year. This year also, we have had certain one-off expenses of a very high nature in our indirect costs and sales and marketing costs, which will not be repeated next year. So I don't think there would be any meaningful margin expansion this year, but hopefully next year we can see that happening.
When you say meaningful and substantial for FY20, sir, how should we read that? I mean, we're talking 100 basis points, more or less? I mean, some idea of how to understand it?
Yeah, but it's predicated on the back of a low inflation trajectory happening. If that doesn't happen, then margins would once again come under pressure. But inflation outlook does seem to be benign, so let's hope it stays that way, in which case, maybe 100 basis points is something which we should definitely expect.
Okay, just one final question from my end. If you could just break up, you said broadly that demand has been fairly steady. If you could break that up in terms of metros, non-metros, as well as villages, any trend that you see there?
Well, the highest demand is coming from the sub 50,000 pop strata towns and rural, of course. And then we are seeing pockets of very high demand in modern retail. E-com is trending up very, very smartly. Urban wholesale is trending down, but rural wholesale is doing well. So it's a mixed bag. The enterprise business is not doing too well. Canteens still remains under pressure. So there are a lot of positives and negatives, but net-net, it aggregates into, like I said, high single-digit volume growth trajectory.
Okay. And finally, this question, that's sort of on people's mind. Are you looking at the Ayurvedic space in a bigger way? Are we expecting more launches? Are you perhaps even looking at over-the-counter Ayurvedic medicines or drugs? I mean, anything more in naturals in Ayurveda?
Yes, very much so. I think that's really the centerpiece of our growth strategy. But rather than look at new initiatives and new brands, etc., we're really looking at scaling up many of the small brands in our portfolio. This year, we've taken brands like Honeytus to scale up by putting in additional investments, and they're responding very well. So I think there's a lot which we have within our portfolio rather than to look outside for scale up and growth. And almost all of it is in the naturals and Ayurvedic space.
Okay. All right, so we'll leave it on that note for today. Thank you very much for your time. So that is the word coming in from Dabur. Still looking at low double-digit growth for this year, unless the stimulus ahead of elections is very, very substantial. Also looking at 100 basis points margin expansion in FY20, though he acknowledges there is quite a bit of heightened competition in the entry-level toothpaste categories. That's where they are still getting in pressure. Okay, on that note, we need to take a very, very quick break. Actually, before we take that break, there's a story coming in. Motown seems to be on a course correction mode of sorts. Car manufacturers across the board have cut production sharply due to tepid festive season demand. Utkarsh Chaturvedi is joining in with the details. Utkarsh, those numbers did not look good for the month of October and November. What more are you picking up?
So, Survi, what we are picking up will give you a better picture of how the retail sales went during the festive season. Because remember that during the festive season, all the car makers were pushing inventory, hoping for a good festive season to happen, and that has not happened. And that is the reason why they're on a course correction mode. If you look at the numbers, I'll run you through the numbers first and then maybe try and make our viewers understand the implications of it. We're speaking about a 20% cut by car manufacturers last month. And all the inventories, Maruti has cut production by almost 12%, Mahindra has cut production by 26%, Tata Motors has reduced production by 22%. Now, all of this because there was heavy inventories lying with dealers. We have been speaking to dealers across the country, and they have been telling us that they are filled with inventory at this point of time. They have inventory up to 10 to 12 weeks. In fact, the dealers also told us that across manufacturers, they had gone to the companies, OEMs, and had told them about their inventory condition, and they do not want any more vehicles to come in till they exhaust the same. And that has happened. If you look at the current inventory level, it is at 20 to 12 weeks. A normal inventory level for a car maker at this point of time, given that we're talking December, so anyhow inventory slows down because the new stock will come in the new year. We're speaking about a 6 to 8 weeks of inventory at this point of time. Remember, we spoke to Pawan Goenka a couple of days back. He did indicate us that there has been a production cut. He also indicated us a very important point that December also they can see a huge production cut. So we'll have to really wait in January. What he told us is that the retail sales are nice. We'll have to wait and watch till January. The clear picture of how the sales have been in the festive season and now goes on.